Hello and welcome to a brand new show of Market Makers, the show on which we'll debate, ideate and understand which way markets are headed, short-term, medium-term and long-term. Also, we'll focus on sectors and themes where markets are priced to perfection, talk about pockets of opportunity and talk about flows in the global big picture. To discuss all that and much more, I have got the perfect guest, Sanjay Mookim of JPMorgan. Sanjay, fantastic to have you back on ET now. Thank you for joining us. Let me start with your worldview. 2 weeks ago, there were multiple concerns in the market. China, Middle East, what will happen to US macro data. But surprisingly, all those concerns have taken a back seat. So what is your view of the world? Are we back to stability after 2 weeks of heightened volatility?
Good morning, Nikunj. It's great to be on. I think your question has two answers. One, that the underlying volatility drivers are still around, right? It's not like we have found resolution or clarity on many of the questions that are being asked, whether it is the uncertainty in the Middle East and in Europe or the outcome of the US elections. What moves up and down is sentiment in equity markets, right? And that can be very fickle, Nikunj. Today, it's a she loves me, and tomorrow it can be a she loves me not trade. What we'd really like for is some of the major geopolitical questions to be properly answered. And maybe post-US elections, we'll get a clarity on where stuff is heading. So from a market point of view, yes, there will be weeks where people are happy, feeling happy, and people are feeling not happy. But the underlying reasons of uncertainty still persist.
So what should one do in this kind of a world where valuations are not exactly cheap, uncertainty is back, but the force of liquidity will ensure the downside is limited? Because those who are buying now, they fear valuations. Those who are not buying, those who are not participating, they perhaps are losing on the liquidity advantage.
Right. And this is the lesson we've learned over centuries, really, that most asset bubbles that are formed, and I should not probably be using the bubble valuation because who knows where we are, but the inflation of assets is principally a liquidity phenomenon. And correction of valuations or corrections will also then happen when this liquidity starts to withdraw for whatever reason. And as of now, there does not seem to be any imminent threat to that. We cannot predict, at least let's say in India, why flows will slow down, if at all. And that is why people do feel the pressure to continue to participate. But I think your point is very valid, that it's liquidity's positioning and flows, which is dominating the styles and determining the trends of markets in the near term.
Do you think the China comeback trade is a real deal or that already has played out?
I'm sorry, Nikunj, you broke up there for a second.
The China comeback trade, which in a sense was a big factor where flows moved out of India, is that trade over, or that trade could bother flows into India in the near term as well?
I don't think it is completely over, Nikunj, because there is enough being communicated by the Chinese government on a forward path. They are considering further actions, stimulus, and you will see, I would imagine, more announcements coming out of the Chinese policymakers over the next several months, really. And it's not just a last quarter 2024 affair. And therefore, you will continue to see various sort of mood swings in China. If the government announces a major policy action, you'll see the market get excited about it again. If the policy action disappoints expectation, you'll see corrections also. But I think we're at the start of a phase where for a certain period of time, next several months, I would argue, you will see continued policy announcement out of the Chinese government. So I don't think it is over. It certainly looks like a start of some change.
So if I may encourage you to divide the Indian market into three large buckets: cheap and ugly, which is purely in terms of price action; expensive and overbought, which should be avoided; and reasonable and good, where compounding can still happen.
The last bit is easy. The growth at reasonable price. It's a Peter Lynch screen that traditional investors try to use very often. That basket is relatively empty, and the only thing that shows up, if you were to somehow scientifically model it, is the Indian financial. The large cap banks, or even let's say the smaller banks, some financial set shows up as being growth stocks with reasonable valuations. The trouble, Nikunj, as we've all seen, is that the sector has been under pressure for a while. Just performance-wise, it's not kept up with the market. And now we are seeing some pressures on the earnings momentum of financial sector. So there are genuine reasons to believe that the growth momentum will slow down for financials. Cheap, absolute-wise, you'll find some utility companies, I guess. I wouldn't classify it as an ugly basket, really, but utilities have not re-rated as much as perhaps the rest of the market has. So, and you can find something at low double-digit PE in India in that basket. Almost the rest of the market falls in the other, which is in an expensive category. Whether you measure it relative to their own historical price to earnings bands or relative to peers rest of the world, relative to market, or apart from financials, utilities, and a couple of handful of stocks here and there, almost everything qualifies as big reasonably expensive.
In your strategy note, you are recommending what could be called as a barbell strategy. I'll just break it for our viewers, which is that you invest in defensives, but on the other hand, you invest in what are called as cyclicals and industrials. At the current juncture, why are you advocating a barbell strategy? What is the thinking behind it?
There are two incentives there, Nikunj. One, of course, if you are investing in India, you must look at the long-term growth potential of India, right? And this applies both to domestics and foreign investors. The attraction of looking at the Indian economy is the potential for medium-term growth, right? And there's a lot of research we have done, others have done, on justifying the view that India will continue to grow at a very decent clip for the many, many years in the future, right? And therefore, you are always tempted to look for stocks which are exposed to that growth. And that could be the cyclicals, that could be the discretionary sort of companies in India. And that's the growth. It comes with a reasonable price tag attached nowadays, but there is always a bias to it. The reason the barbell comes in, Nikunj, is because we are picking up signs of a little bit of a slowdown in the economy in the near term. This could be backward looking because we've had the elections and the monsoons, which have deterred activity. Government spending is down. Central government spending is down on a YOY basis so far. And the feedback from corporates for results, at least in the near term, is a little bit mixed. And again, given the valuations and expectations have been very extended, it makes sense to be a little defensive very tactically in the near term. So yes, there is attraction from the long-term beta growth stocks in India, but at the moment, it does look like we're hitting a bit of a rough patch.
Why are patterns in India dramatically changing? Same time last year, it was about the rural slowdown and urban consumption spike. Now it's the reverse. Why are we seeing such sharp divergence in such a short period of time?
As a bit of a nuance to that question, we tend to argue it's not necessarily an urban versus rural split. It's more of a rich versus not so rich split, right? It's more about the savings dynamics during the pandemic. Wealthier households, people who maintained their incomes, worked from home during the lockdowns, saw a significant improvement in their savings. Plus asset inflation that we've seen, whether equities or real estate post-COVID, has driven a wealth effect in a certain top cohort of Indian consumers. But if you've been in the lower, let's say, 80% of the economy, you've actually consumed savings through pandemic, right? While nobody had, thankfully, too much of distress on existence, I would argue, but you had costs that ran down your savings. So it's a bit of a balance sheet problem for the lower income households, I would imagine. And that's the divergence that we've seen. The other argument that is made is inflation. Perhaps the inflation felt by households has been higher than has been printed in our calculations. And for a variety of reasons, therefore, the sentiment, and the RBI does these surveys, the consumer sentiment data, has still not got back to where it was in 2019, just about barely there. And remember, 2019 was not a very strong consumer year to begin with. So it looks like the economy is taking its time. Consumers are taking a while to regain confidence in consumption. And that's why we've seen a lagging behavior between the consumption basket exposed to the, let's say, top 10% of Indian households versus the bottom 90-odd%. In theory, this should converge. Whether it is actually happening now is an open question.
One lead indicator of economic growth is always car sales. And PV sales now are in the range of 3 to 5%, which is even lower than India's GDP. So as always, auto has been a lead indicator to predict the direction of consumption cycle. Do you think this time also it will be no different?
Unfortunately, that could be a conclusion, Nikunj. We were hoping that you'll start to see some momentum in car sales into the festive season. Again, channel checks a bit too early. There's still a few weeks to go for Diwali, let's say. But it doesn't look like there has been a significant pickup. The one sort of hesitance we have in overly relying on that metric is there has been a significant inflation in the pricing of entry-level cars. right? So, and all of us are familiar, the first car that you buy was priced at X, now it's priced almost 3X because of steel price inflation, the regulatory changes that we've seen. So the momentum in PV sales has been missing because of the absence of the first time buyer. So there is also a specific issue in the industry to my mind. And as incomes rise and the inflation in car prices it becomes palatable, I hope to see this dynamic improve.
Let's discuss the word capex extensively, first with private sector capex and the government sector capex. I'll start with the government sector capex. The data is out in the open that the government is lacking their capex or the expenditure targets. Do you think they could come back in the second half of this year? And if they do, what it means for the markets?
Yes. Mathematically, the government has 11.1 trillion, central government, let's say, has 11.11 trillion capex target for the full year, Nikunj. They are on run rate way behind the data released until August is behind run rate. There is little reason to believe that the government will have to cut back on that 11.1 trillion rupees target, right? Yes, there is some slowdown in GST collections, but there are other avenues of revenue for Government of India. And as a result, I don't see too much risk in achieving that 11.1 trillion aspirational capex target. And that means that for the remainder of the year, the 7 months remaining in the data from let's say September to March, there should be a significant improvement in the monthly or quarterly run rate of spending coming out of the government in Delhi. And that YOY pickup will be very significant. And this will impact, let's say, the cash flows for the companies in the sector, the orders given out to companies exposed to government capex, etc. There should be a noticeable YOY improvement. This is, of course, tactical, Nikunj. I think the bigger question is where does this 11.1 trillion head in FY 26-27? Our expectation is that it probably grows here on in line with nominal GDP growth, and there is perhaps no more room to grow it faster than government revenues in the forecast 2 to 3 year period.
What do you think it means for basic sectors like steel, cement, defense, railways, because they are dependent on the government capex? Now, if the government capex gets pushed back from first half to the second half, could that lead to derating in some of these stocks?
We've seen some of it. Some of the sectors that you named have been under pressure recently because of a lack of momentum, perhaps on the order outflow, perhaps simply under the weight of performance and valuations, Nikunj. It remains to be seen whether the market will give them credit when the government starts to spend in the second half. But at least that fundamental dynamic we can mathematically model. I mean, government spends on capex in second half will improve. Some of the pressure, therefore, that has been on these sectors could abate technically.
What about private sector capex? There is data which indicates that the private sector capex is not picking up yet. If one looks at the total capacity utilization, it has inched up, it has not shot up. Is there a genuine concern centered around private sector capex?
This is slightly more complicated an issue than everybody sort of, we kind of lump a lot of things together when talking about private capex. If you think of the major heavy industries in India, whether it is the steel, cement, power, infrastructure, these are the sort of projects that employ billions and billions of dollars of capex, right? And let's say this is juxtaposed against building a consumer foods factory, which barely consumes any capital investment, to be honest. The major heavy industries, utilizations are actually higher, right? Whether it is steel, whether it is cement, we're seeing a lot of announcements of new capex. Similarly, on power, the power sector utilizations have gone up to the extent where we almost ran into deficits in the previous summer season. So on the heavy industry side, utilizations appear supportive of capex, and frankly, we have seen announcement by a lot of companies in the sector in growing spending. What we sort of debate when we talk of private sector capex is the broader universe, right? Will the thousands of companies listed, unlisted in India take up spending? And that doesn't really seem to have too much momentum yet. And one of the things I think holding people back is a recent aversion to leverage. Indian corporate balance sheets are very clean. Companies are very under-levered. Perhaps given the experience in the 2017, 18, 19 sort of periods on the bankruptcy processes, I don't think that leverage is coming back in a hurry. The last point I'd make on aggregate investment or capex in the country, the total number is not that bad at 32-33% of GDP. This is a fairly healthy rate of investment. If you exclude the pre-GFC and the 11-12 bubble that we had in overspending in the economy, it is not like we are undershooting on total investment to GDP at the moment.
So Sanjay, if there are traces of a mild slowdown in the economy, if the government capex is slowing down, and if the word leveraging which you used, the corporate sector is slightly averse to leveraging, then what makes a case to buy into banks? Because banks are a proxy on economy. They do well when either retail balance sheets are leveraging, or corporate balance sheets are leveraging up.
Well, the simple answer to the question, Nikunj, is first, this is the one large cap space in India where valuations are palatable, right? And that becomes a very good starting point to examine the investment case. And these stocks have not re-rated in the entire rally that we have seen post-COVID, especially the large cap, let's say, financials. Momentum on earnings was very strong, 22, 23, but the stocks did not perhaps track the earnings delivery. Now the momentum is slowing. I don't think you will get any debate from people arguing that the YOY growth rates for financial earnings is acting to be weaker now. But they still tend to be relatively inexpensive and relatively cheaper than the rest of the market. So if you have an investment case or investment horizon of, say, 2, 3, 4 years in India, the banks and financials, despite the near-term possible deceleration, still appear as the best case investment ideas.
Okay, I like to specifically talk about manufacturing renaissance because it forms a prominent mention in your India strategy report. What is the best way to understand manufacturing? Is it all about EMS? Is it all about the semiconductors and the new sectors which are getting created, or it is just beyond this one sector?
There is a saying, I don't know who, it's attributed to many people on the internet, Nikunj, which is that we over-expect changes in a two-year horizon and under-appreciate changes that will happen or occur in a 10-year horizon. And I think India's manufacturing renaissance sort of fits that bill. That because of the various policy initiatives, of the measures that have been taken in the economy, we're all looking at the numbers now and saying, oh, look, what has changed? And if you actually do that, it's not very apparent. The manufacturing intensity of GDP has not really moved up. India's net merchandise trade number has not again moved as much as you would have hoped. These things will matter. They will matter on a longer time frame than perhaps the market has patience for. And to your direct question, this is far more broad-based, right? In a variety of industries, there has been an incentive to manufacture locally. There has been a tangible improvement in the business environment, I would argue, and the comfort that companies in India have in setting up manufacturing facilities in India has improved significantly. So yes, the market is familiar with the sectors you named because there are stocks listed here, but across industries, we are seeing a greater incentive for businesses to produce locally.
It was Eric Smith who said that we are overestimated the rate of change in the short term, underestimated in the long term. So let's take that point forward now, and I'll throw in one more ingredient in the melting pot, which is energy transition. What is your house view on energy transition? Should one lean towards thermal? Should one lean towards solar, wind? It's a big sector which is going through massive change, and for those who will get it right, I guess would be handsomely rewarded.
Yes. The challenge that India has, Nikunj, it's not just the transition that we have to worry about. We also have to fund our growth. And what I mean today is, let's say India's economy is little under $3,000 per capita. We aspire to be that $7,000, $8,000, $10,000 per capita. And energy consumption, at least in the initial bit, rises along with your living standards. And as per capita GDP rises, energy per capita will also rise and hopefully then stabilize. India has two challenges. To sort of improve the mix of how you're generating and consuming energy, but also to fund the energy that you will need for your standards of living to improve. And if you do the math, and we've done this in a note a couple of years ago, that the sheer requirement of growth means that you may not be able to cater to all of it only through green energy. And you may have to consider expanding a thermal base of power, coal principally, in order to make sure that you are not short of your energy requirements. And this is a subject that's slightly close to my heart as well. And what I would argue is that if you did sort of press the renewable energy accelerator harder, you run into the challenges of managing the grid. The government regulatory agencies have done their own studies. Beyond a certain percentage of renewable energy, the grid becomes unstable, and you will run into a situation where the grid may have to reject the volatile power. So the solution is to find affordable and reliable storage of green energy, in which case then, of course, the whole dynamic will change. But until a storage solution is developed and executed, you will have to consider expanding thermal capacity in India as well.
So which means the existing incumbents right now, which have a very large presence in thermal, and especially some of the PSU companies in the utility space, you call them utilities, some can call them power generators. Do you think they would remain in business and they would remain relevant for the markets?
Yes, I think they will. Again, because look, India is a growth economy. It's not like we need as much power as perhaps we can generate over the next 10 years. Okay. And like I said, just going back is unless somebody invents or discovers that killer app on energy storage, right? And there is a lot of work happening on that, to be honest. And perhaps we are close to making it work economically. But until that happens, the case for investing in thermal, it still remains very strong, to my mind.
Can I apply the same logic for EVs as well, where everybody is excited about this China model where 25% of the cars sold would be EV? And if China mein hua, to India mein bhi hoga. Do you think there is excess excitement in the EV space in India?
I'm not sure there is excess. I mean, people in India are, I think, very pragmatic. We have seen penetration on electric mobility improve significantly, whether it is supported by government initiatives in public transport or in the two-wheelers, where the total cost of ownership of a EV two-wheeler is now lower than a ICE two-wheeler as well. And by sheer dent of economics, the market has adapted whatever it can. For passenger vehicles, I think the question on economics is a little less clear, to be honest. But if we do get to that tipping point where total cost of ownership, the resale values of EV cars becomes reliable, I think you don't need too much else in the market. And this is a genuine business solution, to be honest. It just needs to become obvious to Indian consumers before the pace of change improves.
Who would be the eventual winner in this entire EV stroke the vehicle transition race? Would it be the challengers or would it be the incumbents?
We've seen enough evidence across industry that incumbents are also able to adapt, right? Whether it is on, let's say, energy generation or mobility, etc. Just the fact that technology is changing is not necessarily a death knell for incumbents. It is possible for people who have been in the industry who to adapt new technology and to reinvent themselves. And one of the challenges that people face in India is of distribution, right? And the incumbents enjoy that advantage and can therefore afford to be a little late in the technology transition. We've tried all kinds of models of online selling, etc., but everybody eventually realizes that in India you do need to have a distribution network for a variety of business.
And just to wrap it up with one final question, which is that we've seen prominent evolution in business models. The Jam Trinity changed everything for financials and for fintech. Similarly, the advent of smartphone has given birth to models like Zomato and Swiggy. What is that one big change you think it is on the anvil which will have very far-reaching impact, something which is small today, something which could be disruptive or something which could really scale up some companies who adopt that technology or that process?
I've been trying to read up and track, and because, like I said, it's close to my heart, the energy storage space, and because that if that works, and if we can get the price of BESS or any sort of storage electricity down to break even and make it economically viable, it will change the prospects of the economy meaningfully, permanently, right? And what I hear from people I speak with is that we are getting there, right? We probably aren't there yet. There's a lot of companies in India, Nikunj, who are investing in green energy, in hydrogen technology, etc. But in my assessment, the economics are not there yet, but it's heading in the right direction. So the potential impact, the scale of impact of achieving economic storage is massive.
Any parallels in the world where the electricity storage as a concept has worked?
It's worked in high-priced markets where the power prices are high enough for you to be able to afford that kind of storage technology. Every market obviously has different pricing environments, and given the Indian pricing, I don't think it's there yet. But there are enough examples where people have built storage, electric storage, for many years now and continue to operate them economically.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.
Hyundai Motor India Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 1,865 to Rs 1,960 per equity share of face value of Rs 10 each. The anchor investor offer period opens and closes on Monday, October 14th, 2024. Offer opens on Tuesday, October 15th, 2024. Offer closes on Thursday, October 17th, 2024. For risk involved and other details, please refer to the red herring prospectus, which is available on the website of the company, SEBI, BRLMs and the stock exchanges.